Welcome to Making Money. This is Matt McCall. Thanks for joining me. It's the 10th of October, 2023. It's a beautiful Tuesday back in the United States of America. We got a big show coming up. We're coming up on the 1-year anniversary of the bottom of the S&P 500. We're going to analyze the first year of this bull market. What is it telling us? Has it been weak? Has it been strong? Will it continue? All that more coming up right now on Making Money. Do you own one of America's 7 most dangerous stocks? These 7 stocks have been on a tear this year, driving about 75% of all the gains the S&P 500 has seen in the first half of 2023 and leaving the other 493 in the dust. But here's what most folks don't know. Owning even one of these stocks could be a dangerous mistake. That's because what's around the corner for the stock market could catch you off guard. It's a distinct pattern that happens roughly every 10 to 12 years. And each time, it opens a rare window in the stock market where investors stand to create or lose huge amounts of wealth. Right now, it's on the verge of happening again. We put everything you need to know, including the names of these 7 stocks, in a new report we'd like to send you today for free. Get the facts yourself. Go to 7stocksreport.com to get your free copy. You can get the full list of the 7 most dangerous stocks and prepare for what's coming. Again, that's 7stocksreport.com for a free copy of our new report. Again, this is Matt McCall. Thanks for joining me. It's the 10th of October, 2023. Happy, sad, indifferent to be back in the United States of America. It's tough to leave paradise at any point, waking up and hearing the waves, going to bed and hearing the waves crashing. It's tough to leave that. But I'll tell you, in the last 2 weeks that I've been gone, I hope everybody's enjoyed the shows. We did some specials on housing. We had some great guests from the Future Proof Conference out in California that we brought on. And then obviously we've had a lot going on in the market over the last 2 weeks. We had the major averages for the most part pull back until late last week. We'll talk about that a little bit later in the show and why kind of the stocks have gone up as of late with more negative news really hitting the major headlines out there across the world. But we've had a lot going on. We've had a surge in yields in the 10-year, the 2-year, the 30-year. So really all parts of the yield curve have seen a surge in the last couple of weeks. That has sent bond ETFs and bond funds to multi-year lows, which has hurt a lot of people. The drawdown that we've seen, and again, we're talking about that in a minute too. I'll show you a chart. The drawdown we've seen in treasuries recently, last couple of years, I guess you can say, has been historic, to say the least. And at some point, maybe that leads to a great buying opportunity in bonds. Maybe it's time to actually put some money into money markets and cash where you can get upwards of 5.2% for sitting in a sweep money market. So there's the market has changed a lot in the last couple of years. The last couple of weeks have really brought a lot of this to attention. And that's because we see yields breaking out. We see the fact that home sales have been slowing because mortgage rates are close to 8% now. So all of this that's happened here with the Fed raising interest rates over the last 2 years or so has really come into play as of late. And I've been saying this for over a year. When the Fed raises interest rates, it doesn't just affect the market that day or tomorrow or the next week. It takes time for higher interest rates to make its way into the market, which will slow down borrowing, will likely slow down the economy, will slow down a hot jobs market. It doesn't happen overnight. You know, there's too many academics out there and economists that think they know everything. They think, okay, pull this lever and it's going to be fixed. Welcome to the real world, folks. In the real world, if you run a business, I've run many of them. If the Fed goes and raises interest rates, I don't change my plan tomorrow. But if I go to borrow money 2 months, 3 months, 6 months from now, and it costs a lot more to borrow money, I may not borrow as much. It means I'm not expanding as quickly. It means I'm not hiring as many people. It all makes sense what the Fed's doing. Do I like the way they did it? No. I think they should have just gone real quick, pull up the Band-Aid. But we're starting to see all that finally come through into the economy, into the stock market, into the bond market, the housing market, and eventually we'll probably see it in the jobs market as well. And obviously we're seeing it with inflation coming down. But last Friday, when I was down in Nicaragua, they had a jobs number came out, much hotter than expected. Basically almost double the amount of jobs created than what the economists, those so-called experts. So The hotter than expected jobs number means we're stronger jobs market than what we had expected. When I say we, I'd say just the market itself, economists, etc. You would think that's maybe good, right? It tells us, well, that the economy is actually holding up in the face of these rising interest rates. Well, this is a situation where good news is bad news, because if news is too good, the consensus is that the Fed will then be forced to continue to raise interest rates. My one kind of counter argument to that is, since the last meeting where the Fed paused, the yield on the 10-year is up nearly 50 basis points, 0.5%. So it's priced that in already. It's already priced in another quarter on the upside, if not more. So when the Fed meets the first week in November, it's going to be interesting. Also meet middle of December. So you have 2 more meetings this year. I don't want to get into the Fed today. We'll talk about that as we get closer toward the end of October. But I'll tell you, I think the Fed probably does make a move. But I think if it does 25, which won't do more than that, I'm pretty sure it's priced in. If it does nothing, I think this market rallies and takes off. So let's get into the heart of the show and take a look at the bottom that happened October 13th, 2022. And this is the intraday bottom. On that day, which the 1-year anniversary will be this Friday, which, as I just kind of realized, it's Friday the 13th coming up. I'll be traveling the next day on the 14th to Las Vegas for our annual conference out there. So I can see a lot of you out there. Or if not, you can always sign up for the live stream. We have great guests from myself to Lance Armstrong, to a lot of our other colleagues and editors at Stansberry, to a lot of great guests from Josh Brown, Morgan Housel, one of my favorite books of the last 2 years that I've read. So a lot of great guests, and you can still sign up for live stream on the link below if you want to do that. But looking back, the 1-year anniversary is going to be this Friday. I did some numbers as of yesterday. It's close enough. So the 1-year anniversary of the market bottom that happened October 13th, 2022, the S&P in that day hit a low of 34.91. The intraday high since then, because we've pulled back, obviously, took place the 27th of July of this year. So July 27th of this year, the S&P hit an intraday high, meaning the highest level during the day, of 46.07. That's a gain of about 32% from the bottom to the high, October through the end of July. As of today, heading into today's show, so as of Monday's close, the S&P from that low, that intraday low, up 24.1%. Now, you may say, man, my portfolio is not up 24.1% from that intraday low. And I wouldn't be surprised if it's not up. And I'll tell you why. So looked at the equally weighted S&P 500. Keep in mind that the S&P 500 is market cap weighted. So the larger stocks, the Apples, the Microsofts, etc., they make up a much larger portion of the index, of the 500 stocks in the index. The RSP, which is the equal weight ETF, when they rebalance, every time they rebalance, every stock makes up the exact same amount, which would be 0.2% if there's 500 stocks. So it equals 100%. So everybody's equal weighted, every stock. So whether you're Apple or the smallest stock in the S&P 500, you have the equal weighting coming in every time they rebalance that. So that gain from the low of the 13th of October 2022 through their intraday high for the RSP, the equally weighted, was on the 2nd of February of this year, 24.6% gain. So less than a 32% from low to high. And as of Monday's close, up 13.2%, well below the 24.1% of the S&P 500. So the equal weight, and again, this goes back to a lot of shows I've done about the Mag 7, Magnificent 7, the big stocks, the big tech stocks, which make up a large portion of the gains that we have seen. Now let's look at the Dow. The Dow actually bottomed on September 30th of 2022. And they bottomed out at 28,725. This is on closing basis. A lot of people use a closing basis here for the Dow. The 1-year anniversary rally that began there, obviously, was at the end of September of this year. And that time frame, the Dow was up 16.6%. Now, Ned Davis Research, right? I looked into a paper they wrote, and they talked about looking back at bull markets going all the way back to 1900. So, looking at 12 decades worth of bull markets. And you look at all bull markets, and that lasted at least a year. And no bull market since 1990, believe this or not, that lasted at least 1 year, which obviously the Dow hit the year on September 30th, has gained this little over the first 12 months. So it's been a very weak bull market for the Dow Jones Industrial Average. The average gain over the first year is 39%. As I mentioned, this was up 16.6%. So more than doubles the average of what you normally see. So we'll talk about what that means in a moment, but a couple more numbers. That being said, the average bull market gain of the 9 bull markets that lasted less than a year was 55.7%. So that's, again, looking at ones that lasted less than a year than ended, but they had a huge rally and then ended. So you really don't want that anyway. We want to see something more sustainable. So again, going back to 1990, at 50% of the bull markets with the smallest first-year returns, which obviously this is the smallest, they lasted on average about 2.3 years. So top half, the top 50 percentile of gains in the first year only lasted 2 years, those bull markets. So maybe it's better to be the tortoise versus the hare. And I'm okay with that, because you have to realize this market, this bull market we've been in now for 12 months, is in the face of inflation that's coming down, but still above where the Fed wants it, not even near where the Fed wants it, really. In the face of rising interest rates, geopolitical messes around the world. So there's still a lot of headwinds, and yet stocks have rallied from there. So to me, the last statistic that I talked about here, the fact that it is kind of the tortoise versus the hare, is actually bullish, in my opinion, long term. So a couple of points we want to touch on here. And the big question that I'm getting, I'm going to get a lot of it at the conference coming up in about a week and a half or so, about a week, I should say. Is this a bear market rally, or is this just a weaker start to a bull market? A bear market rally would be that we're in a long-term bear market and just happen to have a rally because you can't go straight down. I don't think that's the case, folks. And again, I have a lot of great stats and charts I'm going to show you here a little bit later. I just don't think that's the case, because we are now at valuations, to me, that are pretty darn attractive. If you're looking at the S&P right now, if you look at 2024 earnings estimates, which we need to be looking at, you're not buying based on 2023. We're in the fourth quarter already. S&P trades about 17 times 2024 earnings estimates, which over the last 10, 15 years, 20 years, not far from the average. The average is probably between 16.5, 17. So you're close to an average. So you're nowhere near this bubble level that people talk about. This bubble, this is nonsense. If we take away big tech, the S&P trades at 14 times 2024 earnings. And I got to tell you, that to me is much more important when we look at that, because when I look at taking out the big tech names, which again, the index gets distorted, but I believe there's actually a lot of great opportunity in the 493 other stocks, great American companies, large American companies in diverse sectors that make up the majority of S&P 500. I think there's great opportunity out there. And trading at 14 times 2024 earnings, it's tough to say no to that. It really is. If anything, setting up for a major pullback outside of the big tech stocks is going to be difficult when you're trading at 14 times earnings. It's going to be difficult to happen. And just looking real quick here at the S&P 500 equal weight that I talked about, as of the 5th of October, year to date, the S&P equal weight was flat. People think, wow, this market's so great this year. Flat. So folks, sometimes you may be thinking, wow, I'm missing out, but unless you're in the big 7 tech stocks, and you probably have some exposure to them in some form, whether it's through 401k ETFs, mutual funds, et cetera, own some of the stocks themselves. But outside of that, this market has been lagging, and it's been lagging dramatically. You take a look at the Russell 2000, which is the small mid-cap index, heading into today, it was down slightly. It was down year to date. So again, take away some of the big names, especially big tech, this market has still been struggling, lagging, which tells me there is a lot of upside here left in this market. And you take a look at some of the areas, folks. Real estate, REITs, real estate investment trusts, as tracked by ICF, the REIT ETF, near year low. Consumer staples, near a year low. Utilities, near a year low, having one of its worst years in the last couple of decades. These are historically areas that you think very safe. REITs pay a nice dividend. You own a piece of land, a piece of a building. Consumer staples. These are things we need to buy. The Cloroxes of the world, that type of stuff. The Procter & Gamble's struggling near year lows. Utilities, stable, typically stable, right? Not big growth engines, but stable, pay a nice dividend, near year lows. So I looked at the top performers from this October low, and you wouldn't be surprised that communications and technology obviously are the two big winners, above and beyond in the stock market. But the best asset class, believe this or not, and you're not getting a lot of play out there talking about this, is Bitcoin, up 84% in that time frame. 84% still, even though it's pulled back. And not going to get too deep into Bitcoin, but I will tell you, it's been trading with much less volatility than it ever has. And I think that's a good move. And I think the SEC, I think they should have approved a spot ETF a long time ago, but I think that they see this lower volatility. This is actually really establishing Bitcoin as a long-term, more credible asset class. And it's still amazing that it's up 84%, and nobody's talking about it. If we look at some of the underperformers, as you just mentioned, utilities are actually down 5% in that time frame. Consumer staples are actually flat in that time frame. And some of the top performers, though, we peaked in July. We talked about that peak in the S&P 500 and pulling back from there, about 10% or more from that pullback. The two that have actually held up pretty well are energy and healthcare. Obviously, oil prices until recently. They pulled back last week until that. Energy prices have been up, oil prices have been up, so they've done well. The best asset classes, though, Bitcoin, euro, pound, natural gas, which has been crushed for the most part, but has been up since that time frame in July. So you're seeing a little bit different leaders since we've pulled back, but I think when we go back up, it's going to be the broad market that leads, in my opinion. So let's take a look at a little bit of a long-term outlook here. And I want to show you this chart. There's a lot going on in the chart. I'm going to explain it here in a minute. But I want to show you kind of where we stand as far as stocks and bonds are looking long-term. Now, there's four little things here, four little charts. Upper left, it shows the S&P 500 versus the average total return. And if we take a look, the average 1 year total return, this is going back to 1928, so nearly a century, is 11.8% a year for the S&P 500. The last year, we're up 21.6. Average 2 year, 10.7. We're only up 1.4. 5 year, 10.4. We're only up 9.9. We're beating it on the 10 year, lagging on a 20 year. So I really want to focus on kind of that 10, 20 year time frame, where a lot of people say, we're due for this prolonged pullback because we've gone up too much in the last decade or so. Well, over the last 10 years, we were a little bit better than the average annual return. The last 20 years, we're actually lagging. So we're kind of in line. This isn't abnormal what we've seen. We've seen more volatility than typical, but this isn't really out of the norm. If you go below that, folks, it shows the 1 year where we rank, percentile rank. The last 1 year, the rolling 1 year return, top 71% percentile, 2 year lagging, 5 year lagging, 10 year right about average, and you can see 20 year, we're in the about 40% percentile. So I mean, 60% of the time it's gonna be better than that. So we're average. It's okay. Like, we can continue with this 10, 11% gain per year and be fine. And that's a heck of a gain. So on the right-hand side, it shows the 10-year Treasury total return, the index versus the average totals. And again, you look at this, boy, oh boy, you look at the 1 year dramatically underperforming, 2 year dramatically, 3 year dramatically, 4 year, 5 year, 10 year, 20 year, all dramatically. And now we look at the percentile down below. This is mind-blowing. In 1 year, bottom 6.5%. Every other one, 2 year, 5 year, 10 year, 20 year, it's going to be the worst ever. Worst ever 20 year. And this goes back, you can see in the bottom what years they go back to. But my goodness, this is mind-blowing to me when we look at this. Because what we're seeing is bond returns that are just historically horrific. Stock returns that are only average. Yet, people tell us yields are going to keep going. Bonds are going to continue to get crushed. Stocks are so overbought, they're going to get crushed. The valuations are terrible. They clearly don't care about history. They clearly don't care about numbers. And half the people are just trying to sell you BS, honestly. They're selling you something, and they're selling it to you by fear. It's all fear, and unfortunately, there's too many people out there buying into it. So I'm going to show you here real quick the spread through the first 3 quarters, the equal weight versus the S&P 500 overall. We talked about that a lot. You can see up top, this is a spread. This is the equal weight versus the market cap weight, which is your normal S&P 500. This is the biggest spread, so it means the biggest underperformance of equal weight through 3 quarters that we've seen going back to 1990. Now, when that happens, you can see the 3 other times that it's been big, and there's nothing even close to that. Going back to 2020, and then 1990, and then I think it's 97, 98-ish. So the bottom one below that shows how it did in the fourth quarter. Well, after that 1990 timeframe, fourth quarter up 7%. They're both about the same. We take a look here at I think it's 98. You're going to see huge returns, 15 to 20%. And then we go back to 2020, again, huge returns, both double-digit percents. There's no rhyme or reason to say if market weight outperforms or the market cap outperforms or the equal weight outperforms. There's no real correlation there. However, what it does show is typically when there is that outperformance, great outperformance of the market cap weighted index versus the equal weighted, fourth quarter does very well. And I think we're going to have a great fourth quarter. I really, really do. And I think we're off to a good start. We'll look at some charts in a moment. Last thing I want to show you is this is October. This is the month when the 10% plus pullbacks, which is a correction, anything above 10% is a correction, above 20% is a bear market, have ended 18 times. 18 times. Nothing's even close. March 10 times. The next is 5. This is typically the month of crashes and a month of bottoms. I don't see a crash happening right now. I think it would have happened already, but I do see this as a month of a bottom. And when I say a bottom, I mean a pullback of a correction. And we're going to show you a chart right here. Here's the S&P 500 ETF. We pulled back from the high that we talked about in July. Great price support there. We also have great price support just from other highs going back here between 410 and 420. We held that. And we rallied on Friday after looking like we could potentially break it on that hot jobs number, but ended up Friday closing higher. We had horrible news about a war that's going on in Israel right now. Think that would affect the markets? No. We rallied on that news. And again, today, we're about an hour or so into trading of another 0.7% on the S&P 500. So we are seeing follow through in the face of some really negative news out there. And you can't fight the action. Technically speaking, and you all know I love my charts, it bounced off very important support and it's rallying from there. That is a really, really good sign, in my opinion. And then just another big picture thing to think about. The third quarter GDP estimate, which will come out here soon, the Atlanta Fed has it growing at 4.9%. That's big growth. And maybe it's too hot for the Fed. Maybe they want to slow it down. But let me ask you this. As an American, we're just speaking of America and America's growth right now and the American stock market and the economy. Do you really want to see it get ruined by higher interest rates just to save inflation? Or would you be okay if inflation hangs around 3%, but people still get jobs? We still have real wage growth, meaning wage growth above inflation. If see a stock market hangs on and looks good. Or do you want to just play the game the Fed's doing and trying to crush the economy, crushing the market, and make a little dance on the table in the Federal Reserve, say, hey, we got rid of inflation? It doesn't make sense to me. Do we want 6-7% inflation? No, we don't, because it affects a lot of people who don't have money. It's the truth. Most times in inflationary times, people have money do just fine. Doesn't matter if their eggs go up double. And a lot of times there's a lot of great asset classes that they invest in that go up. So they make money. It hurts the people in the lower part of the economic ladder. It's just true. So no, I don't want to see high inflation, but I think we need to reconsider destroying an economy, destroying a stock market to just say we have low inflation. It doesn't make sense. Again, too many academics out there that think they know what they're doing, but the real world tends to escape them. We'll see how it plays out. I think valuations, as I mentioned, are still attractive. I think the market right here is a great buying opportunity for some stocks, even outside of my typical realm of growth. I think there's some consumer staples out there, folks, that might be getting ready for buys that pay some pretty nice dividends. And nothing here is a recommendation, but Coca-Cola is a few days off 52-week low. Some of these names, and that we should be drinking out soda, but McDonald's, a couple of days off 11.5-month low. These are some companies that I don't see going anywhere. That's, again, no buy or sell recommendation, but I do see that there's some great opportunity out there. I'm not saying you have to rush out and buy some small cap growth stock. I just think there's some opportunity in the market. And these are companies that are part of that equal weight S&P 500 that I think will outperform in the next couple of years, outperform these big cap and tech names in the next couple of years. Well, okay, folks, we're getting a rally, we're getting a follow through. Things look good. Outside of the geopolitical issues going on the other side of the world, I don't really want to get into that too much, to be honest with you. It becomes too political, but obviously I want peace throughout the world. I want to see people not be dying from over conflict. So that's the bottom line there. But the market continues to move higher. And I don't think there's any reason to believe that we have anything horrible on the horizon, contrary to what many people will tell you. It's not the end of anything. If anything, I think this is the beginning of maybe America changing a little bit, the world changing a little bit. And I'll take the optimistic view that innovation, technological advances, and human beings will come out on top. So I'm optimistic where we're going. Could be a bumpy ride. Will likely be a bumpy ride. But let's keep our eye on the prize, look big picture. And again, get out there, be a better human being, and it will make the world and everything else out there a better place. So again, glad to be back after a little 2-week hiatus. We'll be back on Thursday with Grant Williams, great guest. You definitely want to tune in for that. And then next week, we'll be coming to you live from the conference out there in Las Vegas. We are sold out for anybody who wants to attend it. I apologize for that. But we have lots of live stream tickets. If you're interested, just click on the link here and you can get to watch everything that we do there. 3 full days of amazing, amazing presentations. So again, thanks for watching. I'm Matt McCall, and that was Making Money.
Opinions expressed on this program are solely those of the contributor and do not necessarily reflect the opinions of Stansberry Research, its parent company, or affiliates.